Imagine a single bank, not a government, not an army, not a charismatic leader, but a financial institution so powerful, so deeply entangled with the fate of a nation, that its mere existence lit the fuse of a revolution that would shatter an empire and change the world forever. This isn't fiction. It's not hyperbole. It's the astonishing, largely forgotten story of the Bank of the United States, and how its turbulent life and dramatic death became the spark that ignited the American Revolution's financial soul, and ultimately helped forge the very identity of the United States as a nation wary of concentrated economic power. Most people remember the Boston Tea Party, the Stamp Act, or the battles of Lexington and Concord as the catalyst of rebellion. But beneath the shouts of no taxation without representation and the musket fire echoing to the colonial countryside ran a deeper, quieter current, a growing dread among ordinary Americans of distant, unaccountable financial control. And at the heart of that fear stood not a king, but a bank whose legacy would haunt American politics for generations, influence the drafting of the Constitution, and shape the fierce debates between titans like Thomas Jefferson and Alexander Hamilton. To understand how a bank could cause a revolution, we must first step back into a world where money wasn't just paper or coin, but a symbol of sovereignty, trust, and terrifying vulnerability. In the decade before 1776, the American colonies were awash in a chaotic sea of currencies: Spanish pieces of 8, British pounds, French livres, and a dizzying array of colonial scrip. Paper money issued locally that often vanished in value overnight. There was no central treasury, no unified monetary policy, and certainly no institution that could stabilize this fragile economic ecosystem. Yet, even in this disarray, colonists managed to build thriving economies based on agriculture, trade, and credit. Their financial lives were local, personal, and deeply intertwined with community trust. A merchant in Philadelphia knew his debtor in Boston, not just by contract, but by reputation. A farmer in Virginia settled accounts with his blacksmith not with coins, but with bushels of tobacco or promises honored over harvests. This informal, relational economy worked until the British Empire decided it needed more control, more revenue, and more centralized power after the costly 7 Years' War. And that's when the first real seeds of financial revolution were planted. Not through a declaration, but through legislation like the Currency Act of 1764, which forbade the colonies from issuing their own paper money. Overnight, the colonies' primary tool for managing liquidity and facilitating trade was stripped away. Merchants couldn't pay suppliers. Farmers couldn't settle debts. The economy began to seize up. But it wasn't just about inconvenience. It was about autonomy. Taking away the right to issue money was, to many colonists, as tyrannical as imposing taxes without consent. Money, they realized, was political. Control over currency meant control over livelihoods, over communities, over the very ability to govern oneself economically. And who would benefit from this centralized control? Not the colonists, but London bankers, royal officials, and the British Treasury. The resentment festered. Boycotts erupted. Protests grew louder. But the real turning point came not in the streets of Boston, but in the corridors of power in London, where a new idea began to take shape. What if the colonies had their own central bank, one that answered not to local assemblies, but to the crown? The concept wasn't new in Europe. Sweden had the Riksbank. England had the Bank of England. But transplanting it to America was revolutionary in the worst possible way for colonists. It represented the ultimate financial overreach, an institution that could dictate credit, control money supply, and siphon colonial wealth back to Britain under the guise of stability. Though such a bank was never formally chartered before independence, the threat of one loomed large in colonial minds. Pamphlets circulated warning of moneyed aristocracies, and invisible chains forged not iron but of debt and interest. Figures like Samuel Adams and Patrick Henry railed against financial tyranny as vehemently as they did military occupation. The revolution, then, wasn't just about freedom from soldiers and taxes. It was about freedom from financial domination. When the Declaration of Independence was signed in 1776, it wasn't merely a political divorce. It was an economic one. The new United States had to build a financial system from scratch, and the trauma of British monetary control haunted every decision. Enter Alexander Hamilton, the brilliant, controversial Treasury Secretary under George Washington. Convinced that the fragile new nation would collapse without a strong financial center, he championed the creation of the Bank of the United States in 1791. Modeled partly on the Bank of England, it would issue a national currency, manage government debt, and serve as a de facto central bank. But to many Americans, especially Thomas Jefferson and his allies, this was déjà vu. Here was a powerful quasi-private institution, backed by federal authority, with foreign investors, including British ones, holding significant shares. To Jefferson, it was an engine of aristocracy, a betrayal of revolutionary ideals, and a direct ascent of the very financial tyranny they just fought to escape. The battle over the bank's constitutionality raged for years. Jefferson argued the Constitution gave Congress no power to create a bank. Hamilton countered with a necessary and proper clause, asserting implied powers. Washington, agonizing, ultimately sided with Hamilton. The bank was born, and with it, the first great ideological fissure in American politics, one that pitted urban financiers against rural farmers, federal power against states' rights, and visions of an industrial empire against an agrarian republic. The Bank of the United States didn't cause the American Revolution in the traditional sense. It came after, but it became the living embodiment of the revolution's unresolved financial question. Who controls money, and to whose benefit? Its very existence forced Americans to confront whether their revolution had truly liberated them or merely swapped one master for another. When the Declaration of Independence was signed in 1776, it wasn't merely a political divorce. It was an economic one. The bank operated for 20 years, stabilizing the economy and helping the U.S. establish credit abroad. But suspicion never faded. When its charter came up for renewal in 1811, Congress, swayed by anti-bank sentiment and fears of British influence since foreign investors still held shares, let expire. The result? Economic chaos. Without a central institution to regulate currency or act as a lender of last resort, state banks flooded the market with unstable notes. Inflation soared, confidence collapsed, and when the War of 1812 broke out, the U.S. government struggled to finance its own defense. The lesson was brutal. A nation without a central financial pillar was vulnerable. So in 1816, Congress chartered the Second Bank of the United States. But history repeated itself with even greater drama. This time, the bank became entangled in the presidency of Andrew Jackson, a man who despised banks with almost religious fervor. Jackson, the self-made frontiersman, saw the bank as a monster corrupting democracy, enriching elites while ordinary citizens suffered. Its president, Nicholas Biddle, was brilliant but arrogant, and his political maneuvering only fueled Jackson's rage. The Bank War that followed was one of the most intense political battles in U.S. history. Jackson vetoed the bank's rec harder in 1832, delivering a fiery message that read like a revolutionary manifesto. The rich and powerful, too, often bend the acts of government to their selfish purposes. It is to be regretted that the rich and powerful too often endeavor to sacrifice the happiness of the many to the aggrandizement of the few. He then systematically withdrew federal deposits and placed them in pet banks, state institutions loyal to him. The Second Bank, starved of federal funds, collapsed. And with it, so did the economy, plunging the nation into the panic of 1837, a depression so severe it lasted 7 years. Yet Jackson's victory was absolute in the court of public opinion. For nearly a century afterward, the U.S. operated without a central bank, a direct legacy of Revolutionary-era fears. It wasn't until the financial chaos of the early 20th century, culminating in the Panic of 1907, when J.P. Morgan had to personally bail out the entire banking system, that Americans finally accepted the need for a central bank. Even then, the Federal Reserve was designed with deliberate decentralization to avoid the concentration of power that had haunted the earlier banks. The story of the bank that caused a revolution isn't about a single institution toppling a throne. It's about how the idea of centralized financial power became the ghost that haunted the American experiment from its very beginning. The revolution wasn't just fought with muskets and pamphlets. It was waged in ledgers, in debates over paper money, in the fear that economic liberty was as vital as political liberty. Every time Americans have clashed over Wall Street, bailouts, or the power of the Fed, they've been replaying that original conflict. The Bank of the United States may be long gone, but its shadow stretches across centuries. Proof that sometimes the most explosive revolutions begin not with a bang, but with a balance sheet.